You are sitting in the boardroom of your real estate lawyer's office. The air conditioning is humming, the glass table is polished, and there is a bottle of water in front of you that you haven't touched. You are exhausted. For the past 6 months, you have lived through the absolute hell of the housing correction. You watch the value of your home drop month after month. You stopped sleeping. You fought with your spouse. You finally made the gut-wrenching decision to sell your property, to cut your losses, and to get out before things got worse. It was the hardest decision of your life, but you did it. You listed the house, you endured the lowball offers, and you finally accepted a price. It wasn't the price you wanted, it was significantly less than what you paid in 2022, but it was enough to stop the bleeding. Or so you thought. And today is closing day. You are here to sign the final papers, hand over the keys, and walk away. You expect to leave with $0, maybe a small check for a few thousand if you're lucky, but then your lawyer slides a document across the table. It's the statement of adjustments. You look at the bottom line, expecting a 0. Instead, you see a number in brackets, a negative number. It says negative $112,000. You look up at your lawyer, confused. You ask if this is a mistake. The lawyer shakes their head and speaks the words that will haunt you for the next decade. They tell you that the sale price of your home was not enough to cover the mortgage, the penalties, the commissions, and the fees. You don't just walk away with nothing. But you have to write a check for $112,000 to the bank today, right now, to close this deal. If you don't have the money, the bank will sue you for the shortfall. You have sold your home, you are homeless, and you are now 6 figures in debt to a financial institution that just took your biggest asset. Welcome back to Canada Property Watch, where we expose the hidden mechanics of the financial system that are currently dismantling the wealth of the Canadian middle class. We have talked about the panic selling wave, we have talked about the appraisal trap, and we have talked about the penalty trap. But today, we are discussing the ultimate nightmare scenario, negative equity and the deficiency judgment. And this is the reality that thousands of sellers are waking up to in 2026. The terrifying realization that you can sell everything you own and still owe the bank a fortune. To understand how a responsible homeowner can end up owing 6 figures after selling their house, we have to strip away the marketing myths of the real estate industry and look at the cold, hard math of a leverage cycle in reverse. For the last 15 years, Canadians were taught that real estate only goes up. You were told that your home is a piggy bank, an ATM, a retirement plan. You were encouraged to put down the minimum payment, 5% or 10%, and borrow the rest. This created a massive leverage bubble. When you buy a $1 million home with $50,000 down, you are leveraged 20 to 1. When the market goes up, and that leverage makes you rich. But leverage is a double-edged sword. When the market turns, leverage doesn't just erase your profit, it hunts down your net worth. Let's reconstruct the crime scene of a typical negative equity sale happening right now in the suburbs of Toronto, Vancouver, or the Fraser Valley. Imagine you bought a townhouse at the peak of the market in early 2022 for $1 million. You put down $100,000, a solid 10% down payment. You took out a mortgage for $900,000. Fast forward to today, interest rates have crushed the market. Comparable sales in your neighborhood have dropped by 20%. Your home is now worth $800,000. You are underwater. Your mortgage is $900,000. But the asset securing it is only worth $800,000. On paper, you have negative equity of $100,000. But the math is actually much, much worse than that. This is where the transaction friction destroys you. Most people calculate their equity by simply subtracting the mortgage from the sale price. That is a fatal error. You have to account for the cost of exiting the position. First, you have the real estate commissions. Even in a down market, the standard fee is usually 5% of the sale price, 2.5% to your listing agent, and 2.5% to the buyer's agent. On an $800,000 sale, that is $40,000 gone immediately, plus the harmonized sales tax on that commission. Now you are down $45,000. Next, and you have the legal fees and disbursements, typically another $2,000. Then you have the closing adjustments for property taxes and utilities. But the biggest killer, the one we warned you about in our last investigative report, is the mortgage penalty. If you are breaking a fixed rate mortgage to sell this home, the bank is going to charge you the interest rate differential. Let's conservatively say that penalty is $25,000. Now, let's do the final math. You sell for $800,000. The bank takes the first $755,000 to cover part of the mortgage. The realtors take $45,000. The penalty takes $25,000. The lawyers take $2,000. When you add it all up, the cost to sell is over $70,000. Added to the $100,000 drop in property value, you are now facing a total shortfall of $170,000. You owe the bank $900,000. The net proceeds from the sale are only roughly $730,000. The gap is $170,000. This is the deficiency. And here is the secret that the banks do not want you to know. The mortgage contract you signed is not just a lien on your house, it is a promissory note. It is a personal guarantee. You promise to pay back $900,000. The fact that the collateral, the house, is now worth less is your problem, not the bank's problem. The bank is legally entitled to pursue you for every single penny of that $170,000 difference. This leads us to the terrifying legal mechanism known as the deficiency judgment. Many Canadians mistakenly believe that we have non-recourse mortgages like they do in some American states. In a non-recourse state, if you walk away from your home and mail the keys to the bank takes the house and that's the end of it. They cannot come after your other assets. But Canada is a full recourse jurisdiction. In almost every province, including Ontario and British Columbia, the bank has the right to sue you personally for the shortfall. When you sit at that table with your lawyer and realize you don't have the cash to close the deal, the transaction enters a crisis mode. You essentially have two choices. Choice 1, you collapse the deal, you refuse to close. This triggers a lawsuit from the buyer for breach of contract, and the bank eventually forecloses on you anyway. Choice 2, you negotiate a short sale with the bank. You beg the bank to release the lien on the property so the sale can go through, promising to pay them the difference later. The bank might agree to this to get the property off their books, but they will not forgive the debt. They will convert that $170,000 shortfall into an unsecured loan. They will make you sign a new agreement acknowledging the debt, and the interest rate on that unsecured debt will not be your nice mortgage rate of 5%. It will be an unsecured line of credit rate, often prime plus 4 or 5%, or even credit card rates depending on your credit worthiness. Suddenly you are a renter. You have no assets. But you have a monthly payment of $1,500 just to service the interest on a house you no longer own. This is what we call zombie debt. It is the debt of a dead asset that follows you from the grave. And if you stop paying this zombie debt, the bank goes to court. They obtain a deficiency judgment. Once they have that judgment, they can obtain a writ of seizure and sale. They can garnish your wages, taking up to 50% of your paycheck before it even hits your bank account. They can seize your car. They can put a lien on any future property you might try to buy 10 years from now. They can drain your bank accounts. The bank has a memory that lasts forever, and they have the legal resources to hunt you down until the debt is satisfied. However, the situation becomes even more complex and dangerous if you had a high ratio mortgage, meaning you put down less than 20% when you bought. These mortgages are insured by CMHC, Sagan, or Canada Guarantee. You paid a hefty premium for this insurance, so you might think, great, I have insurance. This covers the loss, right? Wrong. That insurance protects the bank, not you. If you sell at a loss and there is a shortfall, the insurance company writes a check to the bank to make them whole. The bank walks away happy. But now you have a new enemy. The insurance company, CMHC or Sagan, now owns your debt. They have the right of subrogation. This means they step into the shoes of the bank and sue you to recover the money they paid out. And let me tell you, the federal government, via CMHC, and private insurers are even more ruthless than the banks when it comes to debt collection. CMHC has powers that private banks do not. They can intercept your tax refunds. They can garnish federal payments. You are not just fighting a corporation, you are fighting the machinery of the state. This negative equity trap is creating a psychological paralysis in the market that leads to the inventory stagnation we discussed in our panic selling video. Sellers are doing this math at their kitchen tables. They realize that if they sell at the current market price, they will have to bring a check for $50,000 or $100,000 to the closing. They don't have that money, so they simply cannot sell. They are trapped in the property. And they are mortgage prisoners. They pull the listing off MLS and try to wait it out. They pray that interest rates will drop and prices will recover to 2022 levels. But waiting is a dangerous gamble. While you wait, you are paying thousands of dollars a month in interest. If the market stays flat for 3 years, you have burned through another $100,000 in interest payments. You are effectively paying rent to the bank to live in a deteriorating asset. Furthermore, if you are on a variable rate mortgage with negative amortization, your principal balance is actually growing every month while you wait. You are digging the hole deeper. By the time you are forced to sell in 2027 or 2028, the deficiency might have grown from $100,000 to $200,000. And we are also seeing a massive spike in cross-default scenarios. This is where the trap snares real estate investors who own multiple properties. Let's say you own your principal residence, which has plenty of equity, and a rental condo that is underwater. You decide to sell the rental condo to stop the negative cash flow. You sell it, and you end up with a shortfall of $80,000. You tell the bank, I can't pay the $80,000 right now. The bank looks at your file. They see you have $200,000 of equity in your principal residence. They don't just sue you, they trigger a cross-default clause. They say, because you defaulted on the condo loan, you are technically in default on your home loan. They can move to seize your principal residence to pay off the debt from the rental condo. Your family home becomes the collateral damage for your bad investment. This is why diversification within the same bank is a myth. When you owe the bank money, all your assets are in one basket and the bank holds the handle. There is another layer to this tragedy that is rarely discussed, the tax implications of the deficiency. If you are a real estate investor and you negotiate a settlement where the bank actually forgives a portion of the debt, which is rare but happens, the Canada Revenue Agency, CRA, considers that forgiven debt as income. If the bank writes off $50,000, the CRA treats it as if you earned $50,000 in salary. You will receive a tax bill for that amount. So even if you escape the bank, you walk right into the arms of the taxman. You are taxed on the money you lost. It is a cruel final twist of the knife. So, what happens to the people caught in this trap? We are seeing a surge in insolvency filings. Consumer proposals and personal bankruptcies are skyrocketing among homeowners, a demographic that usually has the lowest default rates. A consumer proposal is often the only way out of the deficiency judgment. In a proposal, you work with a licensed insolvency trustee to offer the bank a percentage of what you owe, say 30 cents on the dollar, paid over 5 years. This stops the lawsuits, stops the wage garnishment, and freezes the interest. But it destroys your credit rating for years. You will not be buying another house for a very long time. It is a humiliating, painful process, but for many, it is the only alternative to a lifetime of debt slavery. However, and be warned, if you try to file for bankruptcy to escape the debt, but you still have significant equity in other assets, the trustee will seize those assets to pay the creditors. You cannot just wipe out the mortgage debt and keep your cottage or your expensive car. Bankruptcy is a total liquidation event. The system ensures that you are stripped bare before you are allowed to start over. What is truly alarming is the number of private mortgage borrowers falling into this abyss. If you borrowed from a private lender, a mortgage investment corporation, MIC, or a wealthy individual, because the big banks turned you down, the deficiency process is much faster and much more violent. Private lenders do not have the PR concerns of the big banks. They don't care about bad press. They will issue a notice of sale immediately, where they will sell the house for whatever they can get, often far below market value, just to get their capital back quickly, and then they will aggressively sue you for the balance. Their legal fees are often astronomical, adding tens of thousands of dollars to the debt. We have seen cases where a private lender sold a home for $200,000 less than the mortgage amount, and then successfully sued the borrower's elderly parents who had co-signed the loan, forcing the parents to sell their own retirement home. So, how do you protect yourself if you find yourself underwater? First, you must face reality immediately. Do not wait for the bank to send a letter. If you are planning to sell, get a realistic appraisal of your home. Not what you wish it was worth, but what it will sell for in 30 days. Calculate the commissions, the penalty, and the legal fees. Do the math we did at the start of this video. If the number is negative, you need a strategy before you list. Second, if you have a shortfall, you need to talk to your lender's loss mitigation department before you accept an offer. Do not surprise them on closing day. Sometimes, if you can prove hardship, the bank may allow you to convert the shortfall into a term loan with a lower interest rate, rather than an unsecured line of credit. It is still debt, but it is manageable debt. Third, consult with an insolvency trustee before you sell. If you know you are going to be insolvent after the sale, it might be strategic to file a consumer proposal in conjunction with the sale. This is complex legal territory, and you need professional guidance to ensure you don't commit fraud. But understanding your rights under the Bankruptcy and Insolvency Act is crucial. Fourth, beware of we buy houses for cash scams. Wolves circle wounded animals. When you are desperate and underwater, you will see ads promising to take over your payments or save your credit. These are often predatory schemes where the operator takes the deed to your house but doesn't actually pay off the mortgage. You lose the house, but the debt stays in your name. When the operator stops paying, the bank comes after you, not them. Never sign a title transfer without a lawyer you hired reviewing the documents. The era of easy equity is over. We are now in the era of negative equity, deficiency judgments, and the brutal unwinding of the largest asset bubble in Canadian history. The bank is not your partner. The bank is a secured creditor. And when the security fails, they become a ruthless debt collector. You need to stop thinking about profit and start thinking about survival. This crisis is evolving every single day. As more inventory hits the market from panic sellers, prices will be pushed down further, plunging more people underwater. It is a feedback loop of destruction. And just when you think you have navigated the banking minefield, there is another entity waiting to take a piece of whatever is left. In our next investigative report, we are going to look at the entity that doesn't care about market prices, doesn't care about equity, and has the power to seize your money before it even reaches your bank account. We are going to expose the capital gains trap and the new aggressive tactics of the Canada Revenue Agency. The CRA is auditing home sales from years ago, looking for people who claim the principal residence exemption improperly. If they catch you, they don't just want the tax, they want penalties that can double the debt. You might have sold your house at a profit 3 years ago and thought you were safe. You are not. The CRA is coming for the exit tax. Subscribe to Canada Property Watch. We are the only channel telling you the ugly truth about what happens when the music stops. We don't sell courses, we don't sell condos. We sell reality. Protect your family, protect your signature, and understand that in this market, the only thing that matters is liquidity. If you don't have it, the bank will take everything else. We will see you in the next one.